Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. Today, we'll discuss what the latest U.S. China engagement means for bilateral relations, what China's April economic data tells us about its domestic demand, and whether China is still a key bullish driver for global oil prices. To help us unpack these issues, we're joined again by Liao Na, Chief Consultant of Energy Policies and founder of GL Consulting. Liao Na, welcome.
Thank you. It's a pleasure to be here.
Let's start with the geopolitics. We've seen the two sides agree to establish new U.S. China trade and investment mechanisms. What do you see as the main takeaway?
If I had to sum it up in one phrase, it would be crisis management. This was not a breakthrough in relations, and certainly not a sign that strategic tensions have disappeared. Rather, both sides recognized that the cost of continued tensions had become too high. For Washington, the priority was practical results, things like agricultural purchases, potential aircraft orders, and progress on inflation-sensitive issues. For Beijing, the key objective was stability. China is entering the first year of its 15th five-year plan, and maintaining a predictable external environment is critical for investment, exchange rates, and industrial planning. So what emerged is a more structured and pragmatic relationship. Taiwan remains a firm red line, but trade, technology, and broader economic cooperation remain areas where negotiation is possible.
So, this is less about reconciliation and more about putting guardrails around competition.
Exactly. The relationship is shifting from unilateral pressure toward managed competition. The agreement to establish bilateral boards of trade and investment is significant because it creates a formal mechanism to negotiate tariffs, market access, and procurement issues. That doesn't remove strategic rivalry, but it does reduce uncertainty.
Let's turn to China's macro picture. What stood out to you in the April data?
The key message is K-shaped divergence. The economy is still growing, but the momentum is highly uneven. Manufacturing remains in expansion, especially in high-tech sectors such as aerospace, electrical equipment, and advanced computing. At the same time, non-manufacturing activity has slipped back into contraction. That tells us the recovery is becoming increasingly concentrated in a narrow group of sectors.
And what does the demand side look like?
China's domestic demand remains weak. Fixed asset investment turned negative again on a month-on-month basis, manufacturing investment growth slowed sharply, and retail sales were essentially flat. So while production continues, both consumers and businesses are behaving cautiously. Another important issue is margin pressure. Raw material costs are rising, but companies are struggling to pass those costs through to customers. That is squeezing profitability across much of the industrial sector.
So, for China, exports are still doing much of the heavy lifting.
Yes, exports remain the main support for growth. Without external demand, the weakness in China's domestic consumption and investment would be much more visible.
Let's move to oil markets. Brent recently climbed above $111 per barrel on supply concerns. Is China still the key bullish driver?
Not in the way many people assume. What we're seeing is a supply recovery meeting a very disciplined demand environment. On the supply side, Middle Eastern exports to Asia rebounded sharply in mid-May. China's planned crude imports also rose from around 7.3 million tons per week in April to about 9.75 million tons. Saudi Arabia was the main contributor to that increase.
That sounds supportive for the market. But the demand picture is more restrained?
Exactly. Although China's crude imports are beginning to recover, that should not be interpreted as a sign of stronger underlying demand. China's oil demand actually declined by around 1.4 million barrels per day in April. Refinery capacity utilization fell to just 63%, and refined product exports increased, all of which suggests that domestic consumption remains relatively soft. At the same time, China has not drawn on its strategic petroleum reserves, which means the country still has a substantial buffer. So, what we're seeing is mainly a normalization of imports through restocking and the arrival of delayed cargoes, rather than a meaningful rebound in downstream demand.
So the rise in Brent is being driven more by geopolitical risk than by stronger Chinese demand.
That's right. The market is pricing in supply disruption concerns, particularly around the Strait of Hormuz. But from a fundamental perspective, China is acting more as a stabilizer than as a source of aggressive demand growth.
So the message is clear. On the geopolitical side, the U.S. and China are moving toward a more structured and pragmatic relationship. In the macroeconomic data, China's economy continues to expand, but with a clear split between resilient manufacturing and weak domestic demand. And in oil markets, import volumes are recovering. But China is not driving prices higher through a sudden increase in consumption. Thank you, Liao Na, for sharing your insights.
Thank you. My pleasure.
And for those who would like to follow these developments in a more structured and forward-looking way, GL Consulting acts as your China decoder, helping turn complex policy and market signals into clearer, decision-ready insight for global energy and chemicals professionals. Reach out to us for a sample issue of the latest China Policy Perspective Report for regular analysis of China's policy direction, energy security priorities, and the broader market implications of geopolitical disruption. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to My Steel Commodity Flux, and thank you again, Liao Na, for joining us today. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.